Everyone to the Adjusted for Risk podcast here from the shores of Lake Tahoe. So, in this episode of the Adjusted for Risk podcast, I'm going to expand on my traditional deep dive manager analysis and conduct another battle of two PSN Top Gun award winning managers. So, I will look at both managers side by side and dissect their performance. In addition, I focus on the PSN small cap growth universe and selected PSN Top Gun Award winner managers next century growth small cap growth strategy run by Mr. Thomas Press. Mr. Press has run this strategy since January 1999. The next century strategy will be going up against the Granahan Investments small cap focused growth strategy, which is run by Mr. Andrew Bija. Sorry if I mispronounced that, since December 2011. So first, I'd like to send out a big shout out, congratulations to both strategies for being named a Q3 2022 PSN Top Gun. All right, so with that, let's go ahead and get started with this battle. So as I always do, let's start by looking at returns. During the third quarter, surprisingly, considering all the obstacles in the broad market sell-off during the third quarter, both strategies ended up producing a positive 9.6% return. Like I said, it was very impressive considering the risk-off environment and the struggles the broader equity market had. When you consider the S&P 500 fell negative 4.88% during the quarter. So the small cap growth style was the only U.S. equity style to produce positive returns during the quarter, with the Russell 2000 Growth Index producing a positive 0.24% return. And these two strategies, Next Century and Granahan, small cap growth strategies, benefited from the strong quarter for the small growth style. So over the past 10 years, ending September, both strategies outperformed the Russell 2000 Growth Index on a cumulative basis, and it was by a wide margin. The Next Century strategy produced a 291% cumulative return, while the Granahan strategy came away with a huge 461% return during those 10 years, compared to the 132% cumulative return for the Russell 2000 Growth Index. So the Granahan strategy beat the Next Century strategy, but the Next Century strategy, there's nothing to be disappointed about, as it doubled the cumulative return of the benchmark. However, when you're looking at trailing annualized returns, that Next Century strategy outperformed the Granahan strategy over 1, 3, and 5-year time periods. Meanwhile, that Granahan strategy had the upper hand over the 10 years, which resulted in that strong cumulative performance. Okay, even though that Next Century strategy had the upper hand in the near term, it was that long term, over the 10 years. A Granahan strategy had an amazing run during those first 5 years of this 10-year period. However, that Granahan strategy, while having a fantastic 6 or 7 runs at the beginning of this decade, really struggled over the past 1 year, underperforming the index by nearly 12%. So the poor performance of the Granahan strategy also shows up when looking at 3-year rolling windows or 3-year rolling returns. It had superior 3-year performance during all 3-year periods from that 2012 to January 2021 time period. And that's why I say That's why the cumulative performance was so strong. The first part of this 10-year time period, the Granahan strategy was stellar, and it outperformed during all 3-year periods from 2012 to January 2021. But January 2021 is when that stellar performance faltered and fell well below the performance of the next century strategy until its strong performance this quarter. Despite this steep climb and subsequent steep fall, the Granahan strategy has exhibited better measures of performance consistency. The Granahan strategy had an information ratio of 0.87 over this 10-year time period, compared to the information ratio of 0.63 for the next century strategy over that 10 years. So a similar story when you're looking at other consistency measures, such as the Zephyr K ratio, with the Granahan strategy posting a 33.3 Zephyr K ratio, compared that to the 25.95 for next century. As for risk, nobody should be surprised, considering the big swings in returns for the Granahan strategy, that it exhibits a standard deviation of 24, which is higher than that of the 21.5 for next century and the 19.5 for the Russell 2000 Growth Index. While the Granahan strategy incorporates higher volatility, its solid returns offset the risks, which results in a Sharpe ratio of 0.75 compared to the Sharpe ratio of 0.65 for the next century strategy and 0.42 for the index. So both strategies, despite the increase in volatility and standard deviation, benefited from the higher returns that they exhibited, and that resulted in higher Sharpe ratio than the benchmark. So it's also no surprise that Granahan had a beta of 1.1, while the next century strategy had a beta of 0.99. So for investors worried about capital preservation or protecting the downside, neither of these strategies is really ideal for that type of investor. Both strategies had larger max drawdowns than the index, with the next century having a drawdown of negative 35.5, compared to a max drawdown of 50% for the Granahan strategy and a negative 33.4 for the index. So as you can see, both strategies had a bigger max drawdown, particularly the Granahan when it fell 50% from its peak. All these max drawdowns for the benchmark in these two strategies started in November of 2021. Additionally, both strategies experience higher downside deviation measures, such as semi-standard deviation and downside deviation, than the benchmark. My preferred measure of a manager's ability to limit drawdowns is the pain index, which measures the depth, duration, and frequency of all periods of loss. Does not just measure the maximum drawdown. It's a more comprehensive look at all periods of loss. So this shows the Granahan strategy fares better in limiting drawdowns with a pain index of 6.79 versus 8.6 for the next century strategy. However, both managers have a higher pain index, which means higher frequencies of losses, or those losses are deeper than the index, as the index had a pain index of 5.9. So it goes to show, once again, if you have clients out there, investors out there that are a little bit more conservative, or focused more on capital preservation or protecting the downside, these two strategies might not be a great fit for them, as the benchmark does a better job, and there's other strategies out there that may do a better job of preserving capital. So risk adjusted returns. Now that I've compared both return and risk measures, let's take a look at the return risk trade-off metrics. Previously, I touched on the Sharpe ratio, which the Granahan strategy had the upper hand on next century. As for the Sortino ratio, which uses downside deviation as its measure of risk rather than standard deviation like the Sharpe ratio, the outcome is similar. While both strategies beat the benchmark quite handily, the Granahan strategy had a Sortino ratio of 1.21 versus 1 for the next century strategy. The other risk-adjusted return metric I find very telling is the pain ratio, which uses the pain index as its measure of risk. And it's a very good statistic to use when you're focusing on protecting downside losses and worried about capital preservation. Again, the Granahan strategy outperforms with a 2.7 pain ratio compared to a 1.6 for the next century strategy. And surprisingly, both strategies beat the index, which had a 1.38 pain ratio. When you consider both strategies had a higher pain index, which means more pain than the index, it's those strong excess returns, those strong returns above and beyond the benchmark that provides it better risk-adjusted returns than the index. So moving along, as for style consistency, both strategies are very style pure. It remains consistent with their small growth being a small growth manager. Whether you are looking at a 3-year rolling periods or throughout the entire single 10-year time period, a single computation. As a result, both strategies have relatively low style drift. Despite being style pure on a return-based style analysis basis, the next century strategy has an R squared of 81.5 compared to the Russell 2000 growth, while the Granahan strategy has an R squared of 78.4. So taking it a step further, the Granahan strategy has an alpha of 9.23 compared to an alpha of 8 or 5.84 for next century. So this shows that the Granahan strategy does a better job with either its stock picking, sector allocations, or just market timing with that 21.6 performance attribution residual over that R squared. So while if you're concerned about style consistency, both are great options there, as they're very consistent at being a small growth manager, exactly what they're trying to be. So with that, this has been a very interesting comparison. On one hand, you have the Granahan strategy that started the 10-year period off like gangbusters. However, it's really had a tough go of it over the past year. While on the other hand, you have that next century strategy, which has excelled more recently. Despite that strong run up and steep decline for the Granahan strategy, it displays better overall return with slightly higher risk. However, the high returns offset the higher risks and results in superior risk-adjusted returns. While that next century strategy has exhibited superior returns over the past 3 years, the lower long-term returns hurts the strategy when looking at statistics over a 10-year time period. However, that next century strategy easily beats its benchmark across risk-adjusted return figures. This makes both strategies very compelling for investors, particularly those with a more aggressive investment objective and investors that are less worried about downside volatility and preserving capital. So both make a strong case for being part of your manager lineup, depending on what you value more in your manager analysis. Do you value more in the short term, like using a 5-year time frame, or a longer term analysis, like using a 10-year time periods, may determine what manager you employ. The Granahan small cap focused strategy outperforms across all categories over a 10-year time period. However, that next century small cap growth manager fares much better over a near term or short term, like a 3 or 5-year time period. So at the end, it really depends. Both strategies are fantastic. They beat the benchmark, stellar performance. Focus more on do you like a 10-year time period, a longer period of time, or a shorter period of time when you're analyzing these. Both managers have done a fantastic job, and there's been a long 10-year running these strategies. So it looks like you've got some consistency there. So with that, thank you very much for watching and listening to this episode of Adjusted for Risk. You can find additional episodes on our Adjusted for Risk YouTube channel, as well as the show notes and other insights at our Wealth of Insights from 6,237 feet.com blog. Thank you very much again, and I hope you all have a great rest of your week.